Wie waren wir jetzt drin?
Ganz um 10.
Good afternoon, everyone, and thanks for being with us today. It's the fourth day of the LuxFLAG Sustainable Investment Week 2021. Before we start, however, we would like to take a moment to thank you all for your support during this last very difficult month since the very tragic passing of LuxFLAG General Manager Sachin Venkalas. Sachin was a great human being and certainly a tireless supporter of sustainable finance. He exemplified LuxFLAG with his passion, his ambition, and drive to move to a sustainable future. Thank you. In my role as acting general manager of LuxFLAG, I'm very pleased to see that after only 2 editions, the LuxFLAG Sustainable Investment Week has already gained recognition, and that is thanks to LuxFLAG's associate members who are showcasing this week where they are in a sustainable finance journey. Given the finance industry is on different stages of that journey, this week is about sharing best practices so we all advance towards the goal of making all finance sustainable. For this 3rd edition of LSIW, we thank you for such a positive response with over 3,500 registrations. This is amazing simply, and I'd like to thank to our host partners and media partners too. The 25 sessions over the week cover the latest trends and most pressing issues in sustainable finance. We hope you find them useful, but also find some inspiration in the progress being made to harness finance to help find solutions to our current environmental and certainly also our social challenges at hand. A few words on the housekeeping before we turn to the session. The slides and the recording of the sessions will be made available to you sometime after the LSIW. For Q&A, please use the Q&A function at the bottom right of your screen. In case we don't get to have the time for all the questions at the end of the sessions will be forwarded to the host for subsequent responses to you directly. But now, without any further undue delay, let's turn to the session. And with this, I'm pleased to welcome you all to the 6th and last session of today, hosted by Arendt Medernach. What can I say more about Arendt Medernach than it being actually the leading independent law firm in Luxembourg when it comes to business law, with multiple representatives' offices all over the globe. Moreover, Arendt acts on behalf of a large number of Luxembourg banks, financial sector institutions, and investment funds, and is continuously involved in providing support and advice concerning different ESG and sustainable finance needs throughout the journey towards ESG investing. With that, I'm actually looking forward to hearing from Arendt about their views and insights on carbon credits and investment funds as a topic of today's session. For that, I'm pleased to introduce the excellent speakers we have with us today. On one side, we have Antoine Peter, manager at Arendt Regulatory and Consulting, as well as Valérien de Jamblin-Demeux, advisor at Arendt Regulatory and Consulting. Valérien is also specialized in sustainable finance solutions. With that being said, thanks for being with us, gentlemen. And Antoine and Valérien, the floor is yours. Thank you.
Thank you so much, Michael. Can you hear us all right?
All fine, super, thank you.
Go ahead. Right, perfect. We can get started. Thank you so much for the introduction, and thank you for organizing this event yet another year. I think it's always a pleasure for us to take part. For this year, we had something special in store, and we thought rather than doing the usual regulatory update, which we traditionally do, working in the law firm, we wanted to take the opportunity of this session to focus on a bit more practical issue and a very specific topic, not so much into the regulation, also to highlight that Valerian and myself, we work at Arendt Regulatory and Consulting, so the consulting arm of Arendt, and we tend to have a much more hands-on and sort of operational approach to those issues. So that's why we chose this very topical topic of carbon credits. So why did we choose this topic? We chose this topic because we noticed in the last few months in the interaction with our clients, so I'm talking here mostly investment funds but also banks, that there was a growing interest in, let's call it, this tool. So we'll see that there are different realities beyond, but we noticed as well that it's sometimes largely not fully understood. So we put up together this presentation to be technical, but hopefully not too technical, but still give you the key things and the key insights you need to understand what we're talking about and understand how this can be used and how this could impact you as participant of the financial sector, of the fund industry here in Luxembourg, but also more broadly in Europe. So, for the agenda we have today, give you a bit of introduction on the background around carbon credits and why it's so often mentioned in the news. We'll then go through a few definitions to see what are the various types of, let's call them credits for the moment. We'll then see how the pricing mechanism works for this type of assets or credits, again. We'll see them how you can use them in your funds, and then we want to close the session not with a negative tone, but at least with a warning, because we'll see that there are some limits to the use of carbon credits and it can sometimes be quite criticized. So it is definitely part of the toolkit when we talk about sustainable finance and sustainable future, but it's definitely, that's what it is, it's part of the toolkit, it's not the optimal answer or optimal solution. So, without further ado, the introduction. So, the general framework, the general introduction is quite easy. We know for quite some time now that greenhouse gas emissions play a major role in climate change and global warming. Global warming and climate change is an issue for us because it jeopardizes the way our livelihoods, it jeopardizes economies and the ecosystem and the planet as a whole. So we need to do something about this. And so the easiest, almost let's say straightforward thing we can do is to reduce emissions. So greenhouse gas emission more generally, or carbon emissions. If I ever say carbon emission, please understand greenhouse gas emission, but it encompasses not only CO2 emissions, but also other gases. So to tackle this issue, which has been discussed for a long time, countries and everybody came together at some point a few years in the past, and they signed what is now known as the Paris Agreements. So the Paris Agreement is the sort of international cooperation and the international recognition that we collectively need to do something to reduce emissions. So it has a few interesting features as to how it works. So each country comes up with its own contribution on how much it wants to reduce its emission. There is this idea that regularly we review where we stand and see if we need to strengthen the commitments. And more importantly, we have a long-term target of net zero, so we want to reduce emission, and we have a long-term target also to limit global warming to 1.5 degrees. So that's, let's say, the sort of scientific consensus or pre-agreed goal that we would need to reach to limit the negative effects of climate change and global warming on our societies and the way we live. So those global commitments, they have been also implemented in the EU. So in the EU, it is now in the EU law, and we have our own objectives. So the European Union has an objective of reducing emissions by 55% by 2030, and also being climate neutral by 2050. So which means that economies, companies need to change the way they operate, they need to significantly reduce emission. What I show you on this slide is the current path of emissions So the sad thing we can notice is that global emissions are still rising. So despite all this media attention and despite all those initiatives, they are still rising. So that's what you see, for example, on the top of the slide, and in particular the blue line. And on the bottom of the slide, and in particular the green line, you see the pathway that emissions should take if we want to have a chance to limit global warming to 1.5. So what is quite striking is that we need to do more, and we are definitely not on track to meet those objectives. So to meet those objectives, as I said, countries are getting on board and companies are getting on board. So companies need to change the way they operate, and this is why in the latest month we have seen more and more commitments to net zero. So it happens in the financial industry, but it happens in many other industries, where we have seen companies come forward and say that they will either be climate neutral, they might even be carbon negative, and have net zero commitment. So all this comes from this overarching objective that we need to reduce emissions. So this is very much companies saying, okay, we have a responsibility to be part of this journey, so we will do our share. Obviously, there is also an element of, let's say, marketing, because there is definitely raising awareness on the topic. People are paying attention, so it's obviously very important that companies make this type of commitment. What I want to say on those commitments is you need to be careful about those commitments and not take them for always what they are, because depending on the scope of emissions that are part of those commitments and depending on also the time horizon, you will have more or less realistic and also more or less impactful or credible commitments. So this is something that today is challenged, notably by NGOs, and companies now, they need to be very careful when they make this type of commitments. You have also market initiatives such as the Science Target, which helps. It can be operational companies, but it can also be professionals of the financial sector to set credible carbon emission reduction targets. In any case, regardless of whether they're credible or not, those net zero commitments, they will almost always rely at some point, one way or another, on carbon credits or carbon offsets. So why is that? The first thing you want to do when you're a company and you want to reduce your carbon footprint is look for energy efficiency solutions. You want to look at how you can reduce your emissions. You want to look at how you can maybe purchase more electricity from renewable sources. But at some point, you will almost inevitably arrive to this incompressible carbon footprint. So you can do whatever you want, you will not be able to get rid of this carbon footprint. And this is where, if you want to make good on your net zero commitment, and if you want to indeed achieve the goal that you have set and you have sold to investors or to the broader public, you will need to rely on offsets, on carbon credits. So this is why they are taking so much attention at the moment, and this is why we wanted to have this session today to really see how those tools work and how the financial sector should be positioned and should use them. So moving on to the next slide, we wanted to start, after this introduction, talking about the different types of carbon credits or carbon offsets that exist. You have mainly two types. You will have, on the one hand, the regulated ones, or it's generally what we call allowances. So these are really the rights to pollute or the permits to pollute. So those would be carbon allowances. And on the other side, the unregulated one, which are carbon offsets. So I will start now with the allowances, so the regulated ones, and Valérian will then talk about the unregulated one, and so the voluntary offsets. So allowances are generally traded or emitted in the context of emissions trading system. So because we are in Luxembourg and because we're in the EU, the most close to us will be the EU ETS, so the EU emission trading system. So this is a regulatory legal mechanism that has as an objective to limit emissions. So there are many different features as to how this works in practicalities, and there are a lot of things you should take into account. But the main two features is that this is what we call a cap and trade system. So the cap and the trade, those are the two main features of an emission trading system. The cap is this idea that every year it will be determined by the regulatory body or whoever is responsible for the system. They will determine how much really emissions we will allow and how much emissions will happen. So there is this idea that it's capped, it's fixed, there is a limit, it should not go above it. Obviously, the idea is that every year we reduce the cap, and like this we reduce the emission of the companies or of the entities that are in scope of the system. So this is the cap. Then there is a trade element. The trade element is that every entity which is subject to the emission trading system will be given sort of allowances or shares to be it's shares of this cap of emissions, and those can be exchanged. So the idea is that you will at the end of the year we will calculate the carbon footprint, so we will effectively calculate the emission of every entity of the system, and you will need to surrender as many allowances as you have polluted. So if you have too many allowances, you can sell them to another participant. If you have too many, you can sell them, or you can keep them. If you have too little, you need to buy it. And so there is this trade element, is the second key feature of an emission trading system. With this mechanism, you get a price. You sort of get a price of carbon, and you get a price of those allowances. So the price is determined by really the trading between participants. The initial allocation of the allowances is twofold. Either it is given for free, so this is the technicalities of each system will work differently, but in Europe, part of the allowances will be given for free, the rest will be auctioned. So it's an auction system, and then you get a market price. After the auction, you can also trade them. So any participant to the system can trade the allowances. And with this, you get a price that you need to pay for each allowances, which represents 1 ton of carbon equivalent. The idea is that since you have this price, for some participants, it will be cheaper to sort of spend money on carbon emission reduction programs or in energy efficiency programs rather than buy those allowances. So not only we will reduce the cap, but also we have an incentive, because there is a price on carbon, so we have an incentive to push companies to try to pollute less. And also important, the sort of the money that will be made out of selling the allowances will be used to finance European mechanisms that are here to develop the sort of rolling out of renewables or energy efficiency programs in Europe. So you have conditions as to what countries are supposed to make with the money they earn from selling the EU allowances. So every company opens an account with the registry, you have a main registry, and then you have a market, and you trade EU allowances, and you trade carbon. Obviously, the main actors will be the companies that are subject to the trading system, but you can also have credit institutions or investment firms that will take part in the market. So that's, broadly speaking, the main features of the trading system, the ETS. The European trading system is not the only one. So this is the one closest to us. It's also the biggest in the world. So 90% of allowances in the world are from the European trading system, so the European emission trading system. But you have other ETSs in the world. So as you can see on the map, you have a bit in blue, the one that are mature and work and are already operating. And then depending on the shade of green, it's either we have plans or we are implementing now our ETS. So it's interesting to see that it's a global trend. Why is it interesting? Because currently, under the European trading system, so if at the end of the year you don't have enough allowances under the EU system, there are partnerships that are developing between trading systems in the world, and you could potentially use the allowances of another ETS to compensate for the allowances you're supposed to surrender under the European ETS. So this is, being put in place at the moment, but there are bilateral agreements between various markets, and you start to see more developing a worldwide market that is at least interconnected, and it's not only an EU thing, although the EU is most definitely still the biggest and still the most advanced market. Another important features of trading systems is the scope. You have here on the slide let's call it a pie chart, which shows the various sectors that are covered by the systems. So you see that, I'm not sure I can use a pointer, I don't want to mess up the presentation, but on the right side you have the EU ETS, and you will note that companies that are subject to the European emission trading system are the ones from the energy and the industry sector, as well as the aviation sector, which means that every other company is not subject to the European trading system. So this is a very important feature of an emission trading system, is which are the sectors that are in scope. So in Europe, the companies in scope represent approximately 40% of the EU emissions, of the European emissions. And we are talking about 17,000 installation. So 17,000 plants or installation or operations in Europe. But you see that other trading systems, they will cover other sectors as well, or in addition. In Europe, it's also worth to know that the rules for the aviation system, the aviation sector, are a bit different than from the energy and the industry sector. So the scope of the trading system is important in terms of company and sectors, in terms of gases as well. So when you think about international cooperation, you want to make sure we cover the same gases, and so because some trading systems will focus only on CO2 and will not focus on other gases, the entities, and then the reporting obligation under each system. So this is a bit what we are looking at when we build this international cooperation between trading systems. Back in the EU, and to finish on EU allowances, so carbon allowances, and really the EU trading system, the EU emission trading system. You have here a chart which represents the global emissions in Europe, and you see how it decreases with the red line on the bottom representing the ETS cap. So this is the maximum that we, remember the first feature is that you have a cap, and then you can trade inside this cap. So the cap is decreasing. The trend was minus 1.74% every year, but now after 2021, the European emission trading system is entering in a new phase, and then it will decrease by 2.2% every year. So the cap will decrease by 2%. So it's better, so it will decrease faster. But if you compare it to the blue line, which is the line emissions should follow if we want to reach the 55% reduction by 2030, you see that it's still insufficient. Although overall in Europe, emissions are indeed decreasing, but we're still sort of not on track to meet the 2030 commitments if we follow this line. But generally, to conclude, it's you have a lot of different regulations that revolve around how the European trading system works. And we just touched upon the main features, but when you look at the chart, you see that you can consider that it works. Broadly speaking, it does achieve the main objective, which is provide an incentive to reduce emissions within the company and within the geographical scope of in which it operates. So then I give the floor to Valérian to speak about the next type of credits or tools with respect to carbon emission.
Thank you. So yeah, next to those ETS, you have those carbon offsets, which work, as Antoine mentioned earlier, on a voluntary basis. Indeed, Antoine mentioned several companies that committed to be net zero by a certain year. And the first step for them will be to reduce their emission within their own operation. However, as it had been mentioned earlier, they will not be able to be zero by their own. So what they will do and what they will rely on are those carbon offsets. So here we just wanted to give you a quick example on how it works. And you will have a company that, for instance, will invest in a specific project. Let's say a project which aim at planting trees in a developing country. And in this project, the company will firstly need to register this project in a specific certification body. And the trees, they will grow over the years. And as the trees grow, the certification body will assess or at least estimate the amount or the ton of CO2 which have been sequestrated by the trees. And in exchange of these sequestrated CO2 tons, a certain amount of carbon credits which will be emitted to the company, and the company will then be able to retire those carbon credits in order for them to offset their emissions. So here you have a simple example of how it works. And
so it could be planting the forest, it could also be energy efficiency programs, household efficiency, etc. So you have different types of projects, but the idea is it's always projects that will either avoid emission or sequestrate or absorb emissions. And then in exchange to that, a market standard setters will give you carbon credits, which represents that you can use as offsets.
So here we talked about a certification body, but what is important to consider is that the same certification body can work with various standards. And here what we wanted to show you is that verified carbon standard, which is part of VERA, is actually the biggest standard of the world. And this table comes from the Ecosystem Marketplace Insight Report, which focuses only on carbon offsets, so that's important to mention. And here you can see that in 2021, through August, the total volume of carbon offset which have been emitted, just by verified carbon standards, is at 86% of the total carbon. We already...
No, but we can take the questions at the end.
Something that is important also to point out here, and which we will come back on a bit later, is that you can see the price also vary from one standard to another. And so here you have one thing that makes the price differ, but this is only one of the things. Because as you will see after, there are all other things that can make the price of a standard vary.
So you see different standards, different prices, and different volumes. So
on this slide, we won't spend too much time because, as we said, there are two big kind of carbon offsets, and so you have the voluntary basis and the regulatory basis. But we wanted to point out that there is a third kind of subcategory which exists, which are the carbon insets. And in fact, those carbon insets work roughly in the same manner than the carbon offsets. However, the project in which the company will invest will be made along its value chain. So to give you a simple and quick example, you will have a food company that instead of planting trees, as I mentioned, will invest in a specific agricultural development project, which is, as I mentioned, part of its own value chain. So we can come back on that later if you have some questions, but this is more specific, so we didn't really spend a lot of time on those ones at the moment. So here on the slide, so back on the carbon credits, what we really wanted to show you is the total volume of carbon credits which have been emitted over the years. And here you have several things to keep in mind. The first one is that the number of carbon credits which have been issued have been systematically higher than the total number of carbon credits which have been retired. And this trend has been growing, especially since 2016, with the biggest gap to be seen between the total carbon credits which have been issued and the total number of carbon credits which have been retired to be seen in 2020 and 2021. And something really interesting to know is that despite the growing gap between those carbon credits issued and retired, the average price of a carbon credit still increased over the year. And this is to me a good opportunity to give the floor to Antoine, which will talk about the pricing of the carbon credits on the legal framework.
So, yes, so back on allowances. So here we did a lot talk about carbon credits, so the offsets, the voluntary market. Now I'm back on the allowances. Okay, so I'm back on the regulated type. To talk to you about the price. So we already touched base on how the sort of trading works. You remember you have initial auctioning and then you can trade it between market participants. And then you have a price, you have a market price. So there are specific rules as to how much is put to auction, how much is given for free, and then how much, so allowances, how many, should I say, allowances are put in they have what is called the market stability reserve, which is a mechanism where we set aside allowances that will not be auctioned or given for free, that they can answer some market stress in the future. This also is put in place because in the initial stage of the EU emission trading system, there are too many allowances given, and so there is a stock of allowances out there. And so the European bodies had to come up with a solution to deal with this stock, and so they put this in the reserve, the market stability reserve mechanism, and at some point in time, if it's not used, they will just remove it. So complex rule as to how many are sold and how many are given for free. What is also taken into account when this is calculated is the risk of carbon leakage. So obviously, you know, it's also a competitive element and a question of competitiveness of European companies, because we don't want European companies to pay too much or to lose too much money because they have to buy allowances. So this is typically the case for the steelmaking industries in Europe. You know, if allowances are too high, then, you know, these companies will just shut down and the steel will be made outside of the EU. So this is something we don't want, and this is why part of the allowances are given for free, so that we can avoid this carbon leakage and having industries and, you know, complete operations that are just going outside of the EU because they are not allowed to pay for the allowances. So that being said, on the price, just wanted to give you a few comments. First, interesting, well, I think the first thing that strikes is how it has, you know, skyrocketed and really increased in the last, let's say, year at least. So we'll talk about the reasons why this happened, but before talking about the reason why it happened, I just wanted to point out, it's interesting, here we are early 2020, and you can see really the dip in the price of EU allowances. So this is, you know, COVID crisis, slowing down of the economy, everything shut down. So you feel that, you really feel that in the price of allowances here. I mean, companies were just polluting less. They expected that they needed less allowances. So there was definitely a dip in the price of this. But since then it has really increased. So several reasons for that. First one is since 2021, so here, the rolling out of the European emission trading system has entered in its fourth phase. So it was first introduced in 2005, and it has gone through various phases. There were some specific mechanisms that only existed in the previous phases. So for example, certified emission reduction or emission reduction units, or this type of things do not exist anymore. Now we're in the fourth phase. And one of the main features of the fourth phase is that there will be significantly less allowances. So this, you know, less offer. So obviously it led to a price increase, especially also because in the fourth phase, there will be more allowances set aside in the stability reserve. Also, colder weather. So we expect a cold weather, cold winter. I think everybody is more or less aware of the energy crisis. We are, I don't know if we're facing it, but at least that everybody's worried and talking about. So this means we'll need to produce more, we'll need to pollute more, so we will need more allowances, also a factor in why it has risen. And the final reason why the price has exploded now and is over the 60 euro per ton of CO2, so for allowances, which represents a ton of CO2, is the fact that us, so the financial industry, the financial sector is becoming more and more active in that field. So we will conclude the presentation with that, but quite a few financial investors are starting to purchase this type of assets. And so this also, drives up the price. And then Valerian can speak us about the pricing of offsets, so VERs, the voluntary part of the...
Yes, so since the beginning here, in the example of project that I mentioned, I only talked about the forestry. But as Antoine said, you have plenty of projects. But if we focus on the forestry here, it's because, as you can see here, only for 2021, the volume just for forestry and land use projects accounted for around 50% of the total volume of carbon offsets which have been delivered. And actually, if you consider the forestry and land use plus the renewable energy, so the two first projects, then you arrive at around 90% of the total carbon offsets which have been delivered. Here, something that we really want to mention is that on the forestry and land use, actually the projects which aim at planting trees only represent around 10% of the total volume. And the remaining 90% is more about the conservation of existing forests, which from our point of view is completely different. And another thing is we previously mentioned with the standards that depending on the standard, the average price will change. And here, as you can see, depending on the project, the average price per ton is also significantly different. So it's for carbon offset, it's not as straightforward than with the EU allowances to determine the price, because it will vary based on the project, based on the type of project, based on the standard, and you have other factors to consider which we didn't talk about for now for time constraint. But for example, the co-benefits, or for example, if you contribute significantly to some specific SDGs, those are things that companies want to, and which will also impact the price of specific carbon offsets.
Right, thank you. So now we move to almost the final part of our presentation, and we want to see how we can use them in the fund industry or in your operations. So we have seen EU allowances, not necessarily EU, but allowances on one side, which is regulated type of carbon credits, versus the voluntary market and what is commonly referred to as VERs, so voluntary emission reductions, or carbon offsets. So two types, different mechanism, it works differently, and also, very importantly, different uses and different prices, which is very important to keep in mind. So now let's see how you can use them in a sort of industrial or fund industry and financial sector context. So various uses. The first one, let's say the oldest, probably we can say it's the oldest or the more common way that you will come across this type of asset or tool is to offset a fund or a share class of a fund's carbon footprint. So that's something that exists for quite a while now, but here the idea is that you will have a fund manager which manages a fund and will say, all right, I will calculate the carbon footprint of my fund and I will buy, and in that case, I'm talking about VERs, I'm talking about carbon offsets, so the voluntary part and not the regulated part. They'll say, I will buy some offsets to compensate for the carbon footprint of this fund. So it can be done at the whole fund level, or it could be done for a specific share class. So this is something that exists, and if you want guidance as to how to do that, good practice, the AMF has even issued a sort of guidelines as to good practices for carbon offsetting. So in those carbon offsetting good practices, what is recommended is the first thing very important to consider and to tackle is how you will calculate the carbon footprint. So obviously, if you sell to the investors that you will compensate the carbon footprint of the portfolio, then you need to be extremely clear about how you will calculate it. So calculating a carbon footprint, it relies on very specific mechanism. You have dedicated, specialized people that do that. But depending on the methodology they use, depending on the scope of emissions, you remember the various scopes. So you have scope 1, 2, or 3. So either we're talking about direct emissions, or we're talking about emission from the energy you have purchased, or we're talking about emissions that happen either downstream or upstream in the value chain. So from the providers, or for the distribution of the products, or the use of the products. So depending on the scopes that are considered in the calculation of the carbon footprint, you have a very different carbon footprint. So the first very important thing is the methodology. So where will I get the information? Will I rely on self-declared carbon footprint of the companies I have in the portfolio, or will I hire someone which will apply a specific methodology to calculate the carbon footprint? So what will be the methodology in that case? And what are the scope? What is the carbon scopes I take into account when I calculate the carbon footprint? Then the second big point for the best practice is what types of EERs will I use? So what type of offsets will I use? So when you sell to your investors that you will compensate the carbon footprint of a fund or of a share class, you need to give them information as to how you will do this compensation. So what standard out there will you use to have your carbon credits? So will you use gold standard credits, or will you use Vera credits? So you have a range of choices of people that will issue carbon credits. Which one will you use? And out of these guys, or these different standards, what will be the underlying projects? Are we talking only about forestry projects? Are we talking about household appliances, land use, whatever? So transparency about the type of label, the type of offsets of ERs you will use, whether they are labeled or not, whether there is an independent register, the underlying projects, etc., etc. And the last thing that is tackled in those good guidance, or best practice for offsetting the carbon footprint of a fund, is really how you will structure that from a fees and fund management company relationship. So traditionally the way it works is either a share class or everybody in the fund will pay a premium in the management fee. So you have the standard management fee, and then we'll say, all right, we'll add a few basis points to this management fee, and those few basis points we add, we will use them to buy offsets to compensate the carbon footprint of the fund. This generally makes regulators uncomfortable. It's the case in France, it is the case in Luxembourg as well, because it means that at some point, depending on whether the price of offset will go up or down, the management company of the fund will take a financial risk on behalf of the fund, which generally doesn't sit too well. So in terms of best practice, what you want to do is you want to separate this, and you want to really pay part of the fee to a provider, which will be a third party, and which will buy the offset for you. And then you're really just paying a service, and it's not the management company doing it for you. That's probably the safest way to do it. So you really pay for a service, then you need to have in place, the contractual arrangement, so to compensate if it goes up or down, but it's something you can put in place. So that's the first and most common use or moment you will come across offsets in the financial sector. It's when you want to compensate the carbon footprint of a fund or a share class. Second time you can come across what we discussed this afternoon is really when you invest in this carbon credits, and in that case, it will be most generally on allowances. So I'm not on the voluntary side anymore. I am very much on the allowances. So the regulated type. Here we have an example of an American fund. So what they do is they really buy allowances, and they make money out of it. So they speculate or they will take position on the fact that the price of allowances will go up and down, and then they will resell it. So in that case, it's really seen as an asset of the fund. So this is something that today in Europe is not allowed, or it does not work for investment funds. And we're not aware of European funds that would do that and really have allowances as an asset of the fund. But what I wanted to mention here is that EU allowances are listed in the Mifid framework and the Mifid regulation as financial instruments. And this is since 2018. So since 2018, EU allowances, regulated type, it's listed as financial instruments. Why is that? This is because European bodies wanted to increase the oversight and the monitoring of carbon markets. And putting allowances as a financial instrument of the MiFID means that all the rules around market abuse, AML apply. And this is why it was put in the list of financial instruments, so that we have much more stricter governance and oversight of those markets in terms of insider dealing, in terms of AML. However, does not mean that EU allowances meet the definition of transferable security. And this is at least not the case for the moment. We'll see if it evolves in the future, but at least in the moment, you're not supposed to have this as an asset of the fund in Europe. The last point, and the last time you can come across this tool in the financial sector, is when you will find funds which have for their objective to finance projects that will deliver carbon offsets. So here I am back on the non-regulated part, I am back on the voluntary markets. In those funds, what they will do is they will really they will pool the resources of various investors. Generally, it's big corporates which made net zero commitments and want to receive carbon offsets to meet their net zero commitments. What they will do is they will pool the money, and then they will rely on the expertise of a third party, someone who is specialized in that, and it allows them to make the generation of carbon credit much more efficient, because first you have risk diversification, because the fund will then finance different projects worldwide. So we're not only talking about planting forest in one country, but we're going to plant forest in different continents. So it's risk diversification, because if one forest burns, I still have the other. Also, it allows you to have a bundle or let's say a bigger volume of carbon credits, because you also have banks or investment firms which will act as broker. If I'm a huge corporate in Europe and I need a lot of those offsets, I don't want to go and then buy a few in this provider, buy a few there, buy a few there. I will have someone that sort of gives me, all right, this isn't, they give you the package, and a big package. So this type of fund also allows that. So there are many good reasons why they would do that. So in that case, really, they will invest and they will finance projects, will generate carbon offsets. And at the end of the fund, you generally don't get financial return, but what you get back is carbon offsets. And this is really the point or the purpose of the fund, is to finance projects which will generate carbon credits. So this is a bit three relatively common or straightforward example of how you could use them. And now I leave the floor to Valérian to conclude on maybe a bit of a warning around
yes.
assets.
I see the time, so we won't take too much time for this last part.
No, sorry.
Yeah. So here what we wanted to mention, because here we discussed a lot about the good things about carbon credits, and we didn't say anything wrong about it. We don't have investments in carbon credits, but we thought it would be really important for you also to know that you have a lot of critics about those carbon credits. And maybe, and I'm pretty sure some of you may have seen the interview of Jennifer Morgan, the executive director of Greenpeace, who last week once again mentioned that the offsetting schemes were pure greenwashing. And actually this belief is shared with other market by other market participants. For example, you have a survey which has been led by Refinitiv a few months ago, and a third of the respondents of this survey also believe that offsetting is pure greenwashing. And in fact, one cannot just deny that you have various studies and investigation that have shown a lot of various limits or errors which happens with the carbon credit generation, and notably around the calculation of the total amount of carbon credits. And you even have other critics that goes further, and some studies, for instance, have even shown that some of the projects have harmed the local communities, which is, as you can imagine, completely out of the basic goal of those projects. So in a nutshell here, we want to mention that although we believe carbon credits are great tools, we also believe that they come with significant reputational risk, and we recommend to be careful. However,
we wanted to end on a positive note. There are some issues. There have been allegations that some standards would have overestimated the amount of carbon that was sequestrated or avoided, and then they just issued too many credits compared to what was effectively done. There is, a huge fragmented market with different standards, different rules. This has been identified, and there is a task force which is in place. The task force for scaling up voluntary carbon markets, and they have this vision of creating a sort of label for carbon credits. And so you will have a minimum core principles for carbon credits that you need to meet. And this idea is to harmonize the generation of offsets, also increase the reputation and the confidence of the general public with this type of tool. So definitely still a lot to happen in that regard, but yes, indeed sometimes it's very it can be criticized. It can be seen as you're just buying time, or it delays meaningful action. So something to keep in mind when you consider using this tool. So, and this is why what I meant by the initial statement, it's a tool and it's part of the toolkit, but it's not the only solution. So it sort of takes you to the last mile, and in some cases we have to rely on offsets. And when done properly, those projects, they do have social co-benefits. They do avoid carbon emission, or they do sequestrate some carbon. But at the moment, since it's still largely unregulated, you need to be very careful about who you're working with in that respect. So this is the end of our presentation, and we have a question on whether VERs need to be just for developing countries, or can it, for example, be EU reforestation. So it's not prescriptive, and you can finance reforestation projects in the EU. Generally, it will be done in developing countries. I think the implementation costs are lower, but also because a lot of the projects. So why we don't have so many projects in the EU is because if we don't talk about reforestation, but if we talk about energy efficiency programs, for example. Because we have the European emission trading system, a lot of the energy efficiency projects will be undertaken by the companies that are subject to the trading system. And so they will do this to reduce their carbon footprint. So you can't use this to then generate offset on top of it. So this is why in Europe you have relatively less, you don't have so many projects that generate carbon offsets. For example, it's not so true in the US. So in the US, you will have much more projects, but you can have European projects. But it's a bad example as well. But there was a huge project in Turkey, not directly in the EU, but at least nearby, like a decade ago, which was heavily criticized because it was at the end of the project, it was completely left, and no one was taking care of it. And today, most of the trees are dead. And so this is another example of, there is poor long-term management and engagement of local community in maintaining those projects.
And on that also, just something to consider is, so we mentioned the certification body and the fact that you have different kind of projects. And so we mentioned Vera and Gold Standards, which are the two biggest standards, or I'd say certification body. And for them and for other on the markets, they won't deliver carbon credits for renewable energy projects in Europe, just because for them, those projects would have happened in any case. So here, indeed, it's possible to have those projects in Europe, but you do have some limitation. And a last thing to consider as well, still on this question, is I mentioned a bit earlier the co-benefits. And for big companies, it's always, like I invite you to look on specific websites of big companies. I don't want to quote some of them, but if you look, they will mention that they will offset their carbon emission with those carbon credits. And in addition to that, they also like to mention the fact that those projects have significantly contribute to some of the sustainable development goals that I'm sure you all know at this stage, which is also something, which is also a reason why usually big companies will prefer to invest in developing countries rather than in Europe directly. So I see that we still have 5 minutes, so maybe someone has a specific question.
Actually, Antoine and Valeria, there came also another question through the chat. The question is, and let me read it out to you. Regarding the inherent potential adverse impacts of carbon credit systems, to what extent are fund managers expected to identify those adverse impacts and find mitigating measures? What are some effective mitigating measures? Would you have your view on that?
Yeah, so generally this will be, so the way this works is fund managers will work with a local developer. So you will have a project developer on site in the country, which will be responsible for implementing and developing the project. And after that, so you register the project with a standard setter, so Vera Gold Standard, so with someone which will deliver the carbon credits. And then you have a very strict set of rules that you need to comply and respect with. And that includes strict monitoring by independent third party. And so you need to regularly produce a report on a very, it's very detailed and it's strict on what you need to report on. I mean, it's more or less strict depending on the standard, but it's strict on what you need to report on. It's then verified by a third party, and then only if you meet all the conditions will the standard setter issue some carbon credits. And so the potential adverse impact of those projects is generally part of the condition you need to meet. So within the condition of what you need to report on to get your carbon credits, you will need to show what you have done to mitigate potential adverse impacts.
Perfect. Thank you very much. And now time is running out. So I would like to use the opportunity, I guess, not only in my name, because I learned a lot today, but also in the name of our audience, most probably. Thank you both for the excellent presentation that you have been delivering, and also would like to thank you at Arendt for hosting the session today. Also, big thanks goes to our LuxFLAG team for having made all this happen. And I would actually like to end this session with a quote that I hope will resonate with you from the video that we were showing at the beginning. We now understand that sustainable finance is not just a type of investment, it's a complete shift of mindset. So thank you very much, gentlemen. I'm wishing everyone in the audience a very nice evening. And please be reminded that today we're having another sessions, and our first session tomorrow will start at 9 o'clock and is hosted by Farad Investment Management, focusing on the challenges of ESG reporting. So with that, thank you again and wishing everyone a nice evening. Bye-bye.
Thank you, Michael. Thank you, everyone. Bye-bye.
Bye.